The bot sees price collapse through the lower Bollinger Band. RSI is oversold. Every beginner instinct says, buy now, it has gone too far. The bot does nothing. Price falls again, still nothing. Only when price turns, breaks back upward, and proves that buyers have actually appeared, does the bot enter. That one refusal is the heart of the wayward trading bot. Today we are building the complete logic in MQL5. Signal detection, confirmation entries, position sizing, pending order management, trailing stops, and the tests that expose whether the code is doing what we think it is doing. No fantasy equity curve. No claim that a backtest can predict the next market. Just a bot we can inspect, break, and improve. Start with a blank expert advisor and meta editor. At the top, include the standard trade library and create one ctrade object. That object will submit, modify, and delete orders for us. Then add the inputs we may genuinely want to change without rewriting the code. The working time frame, Bollinger period and deviation, RSI period and thresholds, ATR period, risk per trade, stop distance, entry buffer, trailing distance, maximum spread, trading hours, and a unique magic number. The magic number matters because the account may contain manual trades or other bots. Our code must touch only its own orders on its own symbol. Now create 3 indicator handles, one for Bollinger Bands, one for RSI, and one for ATR. Initialize them inside onInit. If any handle is invalid, initialization fails. The bot should not continue with missing data and pretend everything is fine. This is also where we assign the input magic number to the ctrade object, so every order it creates carries the bot's identity. Inside onDNit, release those handles. It is a small piece of housekeeping, but clean code should leave the terminal the way it found it. Next comes the first important design choice. Signals are evaluated on a closed candle, Shift 1, not the candle currently moving on the screen. Why? Because the live candle can leave the band, return inside, and leave again before it closes. If the bot treats every flicker as a completed signal, the tester may show behavior that is difficult to reproduce or even understand. So we create an isNewBar function. It stores the last bar time and returns true only when a fresh candle begins. Signal detection runs once per bar. Trade management can still run on every tick. That separation keeps the bot responsive without letting it invent 5 new opinions inside the same candle. Now build a function called readIndicators. Use copyBuffer to retrieve the Bollinger middle line, upper band, and lower band from buffers 0, 1, and 2. Read RSI from buffer 0 and ATR from buffer 0. Request values from the last closed candle and verify that every copy succeeds. If the terminal has not loaded enough history or an indicator is not ready, the function returns false. No data means no trade. With the data available, we can define the setup. For a potential long trade, the closed candle must extend below the lower Bollinger Band and RSI must be below the lower threshold. For a potential short trade, the candle must extend above the upper band and RSI must be above the upper threshold. That tells us price is stretched. It does not tell us the stretch is over. This is where the pending order changes the behavior. After a long setup, place a buy stop above the signal candle's high, plus a small ATR-based buffer. After a short setup, place a sell stop below the signal candle's low, minus that buffer. If price keeps falling after the long setup, the buy stop is not triggered. If price keeps rising after the short setup, the sell stop stays untouched. The bot is not buying because the market looks cheap. It is demanding evidence that the reversal has started. For the long trade, the initial stop goes below the signal low with an ATR allowance. For the short trade, it goes above the signal high. The first target is the Bollinger middle line. The average price is supposedly returning toward. But add one validation before sending anything. For a buy stop, the target must be above the entry. For a sell stop, it must be below the entry. If it is already on the wrong side, the geometry of the trade is broken. Skip it. Now we have entry, stop, and target. We still do not have volume. Create a calculate volume function and pass it the distance between entry and stop. First, convert the selected risk percentage into account currency. Then retrieve the symbols tick size, tick value, minimum volume, maximum volume, and volume step from the broker. The raw volume is the money we are willing to lose, divided by the estimated loss per lot at the stop. Round down to the permitted volume step. Never round up. Cap the result at the broker's maximum. If the result is below the broker's minimum, reject the trade. Raising it to the minimum would quietly exceed the risk we selected. And guard every input. If stop distance is 0, tick size is unavailable, tick value is invalid, or the calculated volume cannot be normalized safely, return 0 and reject the trade. A failed calculation is not permission to fall back to a random lot size. Before an order is submitted, the bot has 4 more questions. Is the current spread below our maximum? Are we inside the permitted trading window? Does this symbol already have an order or position with our magic number? And is the entry far enough from the current market to satisfy the broker's minimum stop level? If any answer is no, nothing happens. That last check prevents one of the most annoying outcomes in automated trading. Code that compiles perfectly, then gets rejected by the broker the moment it tries to trade. Now send the buy stop or sell stop with its volume, entry, stop loss, take profit, magic number, and a clear comment. Give the pending order an expiration as well. A mean reversion setup is time sensitive. If reversal confirmation arrives many candles later, it may no longer be the same trade. Expiration stops yesterday's idea from wandering into today's market. The management function runs on every tick. First, loop through open positions, filter by symbol and magic number. For a buy, calculate a proposed trailing stop below the bid. Modify the position only if that stop is above the existing stop, above the entry price, and far enough from the market to be valid. For a sell, reverse the logic. The proposed stop sits above the ask, below the entry, and below the existing stop. The stop can tighten, it can never move backward. Then loop through pending orders. Delete any order that has expired or moved outside the trading window. If your version of the bot trails pending entries with price, apply one strict rule. A buy stop may move down, never up. A sell stop may move up, never down. That lets the order follow an unconfirmed extension without chasing price after it begins to reverse. At this point, the entire flow is simple enough to read in one pass. On every tick, manage existing exposure. On a new bar, read closed candle data. Reject the setup if data, spread, time, or broker rules fail. Detect the stretch. Build the confirmation order. Calculate volume from the actual stop distance. Submit one order and wait. Now comes the part that matters more than the green compile message. Open the strategy tester in visual mode and slow it down. Find a candle that breaches the lower band with oversold RSI. The bot should place a buy stop above the signal high. If price continues lower, the order should remain pending. If confirmation arrives, it should trigger. If time runs out, it should disappear. Repeat the same test on the short side. Then try to break the code deliberately. Increase the spread beyond the limit. Move outside the trading hours. Choose a symbol with a different number of digits and a different volume step. Force a stop distance that violates the broker's rules. Run the test with insufficient history. The safest outcome in every invalid case is boring. No order. Only after those mechanical tests pass should we look at performance. Use the best tick data available to you. Include variable spread, commission, and realistic trading costs. Test more than one market period. Keep an untouched out-of-sample section. Then forward test on a demo account long enough to observe fills, slippage, rejected orders, and behavior around fast markets. A beautiful backtest can show that the code matched one historical dataset. It cannot prove that mean reversion will continue, that your broker will fill the same way, or that the chosen parameters are robust. And this strategy has a clear weakness. When a market stops oscillating and begins to trend aggressively, stretched can become even more stretched. The confirmation order avoids entering immediately but it cannot turn a bad regime into a good one. That is why the finished bot is not the end of the work. It is the first version that is honest enough to test. The wayward trading bot does not predict the turning point. It watches price move too far, refuses the first temptation, and waits for the market to come back for it. Sometimes the smartest line of code is the one that makes the bot do nothing.